Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again our most frequent guest on the show, Michael Oliver. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
And we always like to tell people it's olivermsa.com, olivermsa.com, to learn more about Michael's work. Where do you want to start today, Michael?
Sure, I don't know. Everything's happening out there. Things are popping. The bond market rally is persisting a bit, and it's, I think, largely counter-trend to the S&P on a brief basis, and that as the stock market gets rattled, of course, some investors will buy bonds. It's a counter-trend rally for bonds. We expected it, and it's still ongoing, and now we're starting to get wobbles. And our key focus in stocks right now is not basically the developed markets. We think they're broken. Europe, I think the Nikkei will break in the second quarter. Europe's broke in February, as far as we're concerned, in terms of quarterly momentum. S&P broke, Dow broke, but the NASDAQ 100 and the Internet stocks and the semiconductor stocks didn't. And that's the narrow point of focus right now in our report. In fact, we had one yesterday called NDX in the crosshairs. Mm-hmm. And we're focused basically blind to everything else because we've made a judgment call that those are broken. But the thing that's holding us up is this glaring blow-off in those narrow areas. And we think that's highly vulnerable for a collapse. And we suspect that once it breaks, it will be the leader on the downside, much like it was the leader on the upside. And anybody who's been around markets for decades knows that tends to be the case. When the dot-com bubble broke, they led the downside. They led the upside, they led the downside. Housing stocks up and led the downside, et cetera, et cetera. So we suspect that'll be the better place to be short stocks is once PNQI, which is the ETF for Internet stocks, and SMH, which is the ETF for semiconductors, when they break down, technically, that'll be the best place to be there. Mm-hmm. Meanwhile, in the foreign exchange markets, we've had an attempt by the dollar to rally, which is, again, another futile attempt in our view, and it's wobbled off. It's about a point above its bear market low and about a point from its recent rally high, so it's just sort of stuck, unable to really get a rally going. We think there's more upside now. I think this year the yen's going to join in, which it didn't in 2017. The yen was totally dormant. In fact, we made a note in a recent report that if you look at a yen chart, yen futures that is, and overlay it with a silver chart, they look identical.
Yeah.
Now the yen started the move recently, and I think it's for real. It's rejoining the upside that it began in 2016, but it went to sleep in 17. So now the dollar is going to have another problem, not just a strong euro, but strong yen. And when you put the two of those together, you're talking 70% of the dollar index.
Yeah.
Commodity area, we've got the grains going now, which is they were totally asleep for the last few years. As far as we're concerned, it's total green light on soybeans, corn, and wheat, and it's fresh. And we suspect they have a good percentage upside move coming in the next several quarters. In the soft commodities, cocoa is broken out big time. In fact, I don't watch it that closely, but we defined a breakout about a month ago. We issued a report on cocoa, of all things, and it's went from 2,000 last month. It's 2,500 this month.
Wow, big move.
People look at stocks and trying to make money there, and they can. There's so many neat portions to the menu that are available to investors, and you don't have to use futures. You can use ETFs and so forth. But I think also coffee and sugar, which are the other parts of the soft arena in commodities, will turn up in the next quarter or two and join cocoa. And you'll have a full court press on the upside in the commodity arena, which you haven't had for the last few years. It's been mainly oil and gold and silver and copper. This time I think it'll be across the board. So you think
So you really believe the softs are going to lead the commodity sector in general?
I think they'll not lead. I think they'll be one of the last to turn because, again, the grains have now turned. The metals turned in 2016.
Right.
Oil turned in 2016. And we think that now the foods are going to turn. Grains have already done it, and I think the softs will, as a group, turn up. And once that happens, basically the full commodity arena is shifted to positive. And,
I see.
Usually the trends in the commodity arena, when they turn on an annual momentum basis, and that's what we're looking at, They last for years. They don't last for a few quarters. Remember, they peaked back in 2011, but down through 2016, basically. 5 years of negative performance and net trend decline. But I think all that's reversing now. And, as stocks turn down and commodities up, it'll again be a time to be favoring commodities over stocks. And I think investor preferences will shift fairly rapidly.
Well, they haven't yet, very, very rapidly, not seemingly to any great extent. I mean, if you look at the market capitalization in stocks and bonds, the commodities, if you take all the commodities together, it'd be minuscule compared to, especially the bond market.
Right? Yeah, no argument there. Yeah.
Yeah. So we see a little bit of money coming out. Yeah.
I think already smart money has started to move, not totally out, but out of the stock market because they perceive it as, they can't define it necessarily, but they perceive it as high and overbought and overextended in time and all that, and therefore they get nervous and they say, well, what looks stable, what looks like it's at ground zero? And clearly the grains look that way for the last 2 years. And by our work, they've now turned.
We've had a 9-year bull market in equities, which is almost as long as the bull markets have ever lasted.
Yeah.
And it seems to be the case that the small investors start to get in towards the end as the smart money starts to move out. It's always very tragic, it seems, in most events. The small people finally they're convinced that the risk is gone because the markets have gone up and they never go down anymore, and in they come. You're looking at your MSA 360 weekend report, man, it's so clear that the T-bond and the, certainly the Bund, those markets are really broken, aren't they?
Oh, absolutely. The one I'm waiting on is the JGB, the Japanese government bond futures. They're slipping a bit, but they need to drop another point to join in. And at that point, I actually think the Japanese government bonds could have the greatest traumatic downside.
Yeah.
Because of the way they look on the annual momentum charts is very similar to the bunds and the bonds. Now, the U.S. bonds and German bonds have already broken down. That means rates going up, prices going down. And we think it's a major, major move because it's on annual momentum. I'm not looking at weekly charts or daily. I'm looking at going back 10, 15 years. The JGBs have the same setup, but they haven't broken it, which indicates, well, the BOJ, they're still, God's almighty, and they control their rates. But I think when the bunds, the JGBs break through much below 150, and they're 150.7 right now. You drop another point, close a month there, they're gone. And I think they'll probably have a big catch-up to the other bond markets, and rates will rise, indicating that the BOJ is no longer in control.
Michael, one of the reasons that I've gained so much confidence in your work over the last couple of years since I've been following you, I see your charts, and I see your momentum charts, and I compare them with the price charts. And, for example, I'm looking at the S&P 500 in your weekend report right now, and it's so clear from the momentum chart that the market is broken down, yet you can't make the same. Well, I guess you could to a degree on price, but nothing as definitive as what you see in your momentum charts. And that's pretty much the way it is throughout. And what I've found very often, if not almost always, is the momentum leads price. Would you say that's true?
That's why we have long ago, when we founded the firm in 1992, we always post price charts with our momentum charts so people can see the contrast.
Yes.
See the everyman's chart, which is the price chart. Everybody can see that. It's the bleeding obvious. But the issue is the momentum, and usually at turns, major tops and bottoms, momentum will clearly break first. I mean, it doesn't take a scientist to even glance at the chart and say, oh, that's broken. And then you look at the price chart of that market, and it might not look broken. And that usually is the way it is. Momentum will tend to turn first, and price will then follow suit. And same at bottoms. And therefore, that's why we emphasize momentum trend structure. This is not one of these loop-the-loop things like, MACD or RSI that everybody has on their quote screens.
Yeah,
those things, they loop up and they loop down. We don't look at those things. We're looking at things that are far crisper than that.
Yeah. But your momentum work is really proprietary, isn't it? I mean, it's not something that everybody has.
Yeah.
And
it's
that's
not
what
available on software programs. No, it's not.
No, and you're not selling that either.
No.
All right. Well, I have to ask you with just a couple of minutes left here, 4 minutes, my engineer is telling me. Silver, when I look at that price momentum chart, it looks kind of boring. Nothing very much happening there. We're still a little bit below the momentum line. But what are your comments on silver? You talked that you were comparing them with with the yen a little bit ago, I think it was, wasn't it?
Well, silver did the same thing as gold in the same time period. Early 2016, silver turned up enough to blow out major overhead resistance on its annual momentum charts. Gold did it at 1150 price level. I forget what price silver was at that time, $13, $14 or something. But silver exploded far more on a percent basis in that 2016 surge. If you recall, we turned up in February, and by April, May, June, July, gold was $200-300 off its low, and silver ran all the way up to $21. So on a percent basis, silver had a much bigger surge post the low. But then it fell back, as did gold in 2017, but it fell back and went to sleep. And is right now at 1656, I think is the last quote I saw. Whereas gold is only a few percentage points away from the highs of the last few years. So gold is firm back. It's crowding the top end of its price range, where silver is well below the highs of last year and the year before. So it hasn't performed as well as gold. But when we look at quarterly momentum and annual momentum of silver, I see structures overhead that look essentially determined to happen. In other words, sometimes a structure will set itself up where you can look at it and say, oh, that's inevitable. It's just a matter of when you're going to cross that line. And I would say that in the low 17s, about 1720 plus on silver, you start to break out anew. It's still in an annual positive momentum trend, even though it went to sleep last year. But it's still a positive long-term trend. But it went to sleep. And the question is, when will it wake up and rejoin the trend that began in 2016? I suspect it's very soon. If gold goes through the recent highs, goes through 1350, for example, at a monthly close, I think silver will be blowing through these levels that we've identified in our reports and will engage and probably at that point again outperform gold like it did in early 2016.
Right. That's usually the trend. It goes.
And I think GDX looks very much like gold. Like silver as well. The gold marks, they've gone to sleep all last year.
Yeah, for sure. Tell me about it.
Most people who own them think they went down. Actually, if you look at the chart and are objective, they just went to sleep. Right. And I think GDX has essentially the same type of potential to beat gold on a percentage basis in the next leg.
Right. Well, the thing is, what I'd like my listeners to be aware of is that, we talk to you almost every week about gold and silver, stocks and bonds, maybe a couple of other things here and there. But you cover so many different markets. And, for example, I'm looking at a stock Mosaic, which is the soft commodities, fertilizer, I guess it is, right?
That's right.
And Moo is a way to play. So there are so many things that you cover. And as you say, there's always some market you can make money in the upside. But you've got to have a view of the whole picture. And, of course, most people are Wall Street's happy to keep you just in stocks and bonds. There's lots of other places to go. So, Michael, I want to thank you very much for being with us again. Always a pleasure. Your insights are so valuable. And, of course, they'd be even more valuable for those who subscribe. It's olivermsa.com, olivermsa.com. Thank you so much, Michael. We'll look to do it again next week. All the best to you. Take care. Okay.
Bye-bye.